Hi everybody, my name is Chris Thomas. I'm a Director of One Accounting up in Edinburgh. Thanks very much for joining me on this short video to look at the tax changes from last week's summer 2015 budget that will affect landlords. Now, as you know, this is the first budget that Mr Osborne has announced under the guise of a majority Conservative government, so it's a fair thing to say that he's got tougher over the years, and there's certainly been some unpopular decisions that he's made in his budget that would particularly affect private landlords. What we're going to be doing today is just look at three significant changes that were announced in last week's budget, the first of which is the wear and tear allowance. So the current rules are that if you have a furnished property, you can claim a tax deduction called wear and tear allowance of 10% of the rent that you actually received. And this 10% is designed to cover the actual cost of replacing things like beds, furniture, chairs, carpets, floor coverings, and white goods such as fridges and freezers. What it's not designed to cover is repairs or replacements to integral features like baths and sinks. One option for you is that you can also elect to claim the actual amount you spend instead of the wear and tear allowance. So if you, for example, you have a rental income of £8,000 a year, option one would be to claim the wear and tear allowance of 10% or £800, or if your actual spend on renewals was more, say for example £1,200 on a new sofa, then you could elect to actually claim the amount that you spent, the £1,200. The changes that are coming in from the 6th of April next year is that the wear and tear allowance is going to be removed completely, and you can only claim an income tax deduction when you actually spend the money. So the effect of this is going to raise £205 million a year in extra tax, and significantly it's going to increase income tax for landlords who actually spend a small amount on renewals, because they'll no longer be able to claim the 10% wear and tear allowance. The tax tip for you is to consider delaying any expenditure on renewals until after the start of the next tax year if it adds up to more than 10% of rental income. So say for example, again, we had rental income of £8,000. Option one would be to claim £800 of wear and tear allowance, but if you were going to say spend £1,500 on some new carpets and you're planning that already, if you actually delayed that until the start of the next tax year, then not only can you claim the 10% wear and tear allowance in this tax year, you would be able to claim the higher amount, the £1,500, at the start of the next tax year. The second change is to mortgage interest relief. So at the moment, any landlord who has a mortgage on a property can claim full tax relief on the interest that they pay, such as a buy-to-let mortgage. If you're a 40% taxpayer and you have mortgage interest payments of say £5,000 a year, then what you're actually doing there is reducing your tax bill by £2,000 a year. So the change that's coming in April 2017 is that the amount of tax relief that higher rate taxpayers at 40 and 45% can actually claim is going to reduce over a 4-year period. So by the end of the 2021 tax year, these landlords will only be able to claim tax relief at 20% of mortgage interest costs rather than 40%. But if you're a 20% taxpayer and you have a rental property, then you're going to be unaffected by this change. So what it actually is an attempt by the government to take some of the heat out of the housing market, and you'll see here from the snippet that I put in from the budget policy paper, there's a view amongst the Bank of England that buy-to-let mortgages could actually pose a risk to the UK's financial stability. As you know at the moment, a lot of the increase in property prices can actually be driven by pockets of buy-to-let landlords. So it's an attempt by the government over the long term to actually take some of the heat out and make buy-to-let investing less attractive. So if you've just got, say, 1 or 2 properties, you're unlikely to be affected too much by this change. But if you've got multiple properties and these are heavily geared with high mortgages, then this is going to present a significant change to your business model. And what you might actually see is that it's possible to make a rental loss and still have to pay tax. And you'll see there at the bottom, expected to raise 225 million of extra tax in 2018, going up to 665 million by 2021. So the tax tip here, and it's quite a big tax tip, is that you should consider setting up a limited company, a property company, if you're thinking about acquiring new properties. You can also use this property company to acquire existing properties that you own personally, but bear in mind that you will have to pay stamp duty potentially on the change in ownership. but the property company can still claim all of the tax relief that it might pay on loans or mortgages. But one disadvantage of a company owning the property is that the company cannot claim capital gains tax relief, and that's currently £11,000. So if you own a property personally and you sell it, the first £11,000 will be tax-free. And the last change is a small change, and it's the rent-a-room relief. So at the moment, if you rent out a room in your own property, the first £4,250 of rent that you receive for that is tax-free. This amount hasn't actually been changed since 1997, so it's going up from April next year to £7,500. The actual cost to the Treasury of this is fairly small by comparison with the previous two changes. It's just going to cost them £10 million a year. So that's the end of the video. I hope you found it very useful, and if you have any changes on the rule changes, then by all means please do give me a call. It's Chris Thomas at One Accounting, and there's my number there, 0131 220 0152. Thanks for watching.